Welcome back to the channel. Today, we are going on a deep dive. If you've been feeling like you're working for the government instead of yourself, this video is for you. We aren't just talking about basic deductions like buying a box of pens for your office. We are talking about deep-level tax strategy. Before we hit loophole number 1, we need to clarify the difference between tax evasion and tax avoidance. Tax evasion is illegal. It's lying about what you make. Tax avoidance, however, is a professional sport. It is the art of using the law exactly as it was written to keep as much of your hard-earned money as possible. Judge Learned Hand once famously said, "Anyone may so arrange his affairs that his taxes shall be as low as possible." He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. In 2026, the tax code has shifted again. With new technology and new business structures, the opportunities for small business owners have never been greater. If you sit through this entire 40-minute masterclass, you will have a better tax education than 90% of business owners in the United States. Let's break down the first strategy, which is often called the secret weapon of the wealthy homeowner. Loophole number 1 is the Augusta Rule, or IRS, Section 280A-G. This is named after the Masters golf tournament in Augusta, Georgia, where residents lobbied to be able to rent their homes during the tournament tax-free. But here is what the IRS doesn't advertise. This rule applies to every homeowner in America who owns a business. Here is the technical breakdown. Your business is a separate legal entity from you. Your business needs a place to meet. While you could go to a Marriott or a WeWork and pay them $1,500 for a conference room, you could also rent your own home to your corporation. The rule states that if you rent your personal residence for 14 days or less per year, that rental income is not taxable to you personally. However, the expense is 100% deductible for your business. Let's do the math. If you hold a monthly board meeting at your house to discuss strategy, and the fair market value for a luxury meeting space in your zip code is $1,200 per day, your business writes a check to you for $1,200. You do this 12 times a year. Your business just got a $14,400 deduction, lowering its taxable income. Meanwhile, you received $14,400 in your personal bank account, and when you file your Form 1040 at the end of the year, you don't even have to list that money as income. But be careful, you must document this. You need to keep meeting minutes, an agenda of what was discussed, and you must have a comparable quote from a local hotel to prove that the rent you charged your business was fair. If you just move money without a paper trail, the IRS will call it a disguised dividend and tax it. This is why the master in this loophole is the documentation. Now, let's move to something a bit more technical but much more profitable, the S-Corp election. If you are an LLC, you are likely being hit with what we call the success tax. When you make $100,000 as a standard LLC, you pay income tax, but you also pay a 15.3% self-employment tax on the entire amount. That's over $15,000 just in Social Security and Medicare taxes. When you elect S-Corp status, the game changes. You become an employee of your own company. You pay yourself a reasonable salary, let's say $50,000. You pay that 15.3% tax on the $50,000. But the remaining $50,000 of profit is taken as a shareholder distribution. Distributions are not subject to self-employment tax. By making this one election, you just saved about $7,600 in taxes. That's a vacation, a new piece of equipment, or a contribution to your retirement fund just by changing how you are classified in the eyes of the IRS. But what is a reasonable salary? This is where business owners get into trouble. You can't pay yourself $5,000 a year if you're making $200,000. The IRS uses tools to see what someone in your position, in your city, would normally earn. If you're a consultant in New York, Your salary needs to reflect that. We recommend using a reasonable salary study to back up your numbers. In this video, we are going to explore how to calculate that precisely so you stay off the IRS's radar while keeping your tax bill at rock bottom. Now let's talk about one of the most heartwarming yet hyper-profitable strategies in the tax code: hiring your children. Most parents give their kids an allowance for chores. That is a mistake. An allowance is paid with after-tax dollars, meaning you've already been taxed on that money and then you give it away. When you hire your child to work for your business, those wages become a tax-deductible business expense. For 2026, the standard deduction is approximately $15,000. This means you can pay each of your children up to $15,000 per year for legitimate work, and they will pay zero federal income tax on it. Think about the math. If you have 2 children and you pay them each $15,000 to manage your social media, clean your office, or model for your brand, you have just shifted $30,000 from your high tax bracket to their 0% tax bracket. You've effectively kept $30,000 in the family that would have otherwise been taxed at perhaps 24% or 32%. But here is the advanced strategy. Take that $15,000 and put it into a Roth IRA for the child. Because it is earned income, they are eligible. If you start this when they are 10 years old, by the time they reach retirement, they could have millions of dollars in a completely tax-free account. To do this legally, you must follow 3 rules. First, the work must be age-appropriate. A 7-year-old can model or shred paper, but they probably can't do your high-level bookkeeping. Second, the pay must be reasonable. You can't pay them $100 an hour for filing papers. Third, you must keep a time log and pay them via check or direct deposit into their own bank account. Treat them like a real employee, and the IRS will treat your deduction as a real expense. Loophole number 4 is a favorite for business owners who need to upgrade their equipment or vehicles. It's known as Section 179 and bonus depreciation. Normally, if you buy a $60,000 piece of machinery or a vehicle, the IRS makes you depreciate it, meaning you take a small deduction every year for 5 to 7 years. Section 179 turns that on its head. It allows you to accelerate that depreciation and take the entire deduction in year 1. But there is a very specific trick used by high-earning Americans known as the heavy SUV loophole. If you purchase a vehicle that the IRS classifies as heavy, meaning it has a gross vehicle weight rating, GVWR, of over 6,000 pounds, you can often write off the entire purchase price in the first year, provided it's used 100% for business. This includes vehicles like the Ford F-150, the Cadillac Escalade, or even the Tesla Model X. Imagine you've had a record-breaking year and you're looking at a $100,000 tax bill. You decide to buy a $100,000 heavy truck for your business operations. By using Section 179, you could potentially wipe out that entire $100,000 in taxable income, saving you around $30,000 to $40,000 in actual cash. A word of warning for 2026. Bonus depreciation is beginning to phase down. While it was 100% in previous years, it's vital to check the current percentage for this year's filing. Regardless, Section 179 still allows for massive immediate write-offs. Always ensure you keep a mileage log to prove the vehicle is used for business at least 50% of the time, or the IRS will recapture that deduction and send you a bill later. Next, let's address the most misunderstood deduction in the tax code, the home office. Many accountants will tell you to take the simplified method, which is just $5 per square foot. That is often a waste of money. To maximize this loophole, you want to use the actual expense method. Your home office isn't just a desk, it's a percentage of your entire life. If your home office occupies 15% of your home's total square footage, you get to deduct 15% of almost everything. Your mortgage interest, 15% deduction. Your electricity, water, and gas bills, 15% deduction. Your home insurance and property taxes? 15% deduction. But it goes deeper. Did you pay to have the entire house painted? You can deduct 15% of that. Did you install a new security system or a new roof? 15% of that cost is now a business expense through depreciation. The golden rule for the home office is exclusive and regular use. This means your office cannot be the dining room table where you also eat dinner. It needs to be a dedicated space. Pro tip for 2026, take a photo of your office today and keep it in your tax file. If the IRS ever asks, you have visual proof that the space is a legitimate place of business. This is one of the most consistent ways to turn your personal living costs into tax-deductible business growth. Number 6 is a corporate secret that every small business owner should adopt: the accountable plan. This is a formal agreement between you and your business that allows the company to reimburse you for expenses you paid personally. Without an accountable plan, if your company gives you $500 to cover your cell phone and internet, that $500 is considered taxable income to you. You have to pay income tax on it. However, with an accountable plan in place, those reimbursements become tax-free. Your business gets the deduction, and you get the cash back in your pocket with no tax hit. This covers things like business travel, professional development, home office supplies, and even your personal cell phone plan if you use it for client calls. Setting this up is simple but requires a written document. You must submit expense reports to your own company, just like an employee at a big corporation would. By staying organized and reimbursing yourself correctly, you can effectively live a significant portion of your life through your business, using pre-tax dollars for your essential technology and communication needs. Loophole 7 is the Research and Development Tax Credit, and it is arguably the most powerful tool for businesses that create things. Many owners skip this because they think it's only for tech giants like Apple or Pfizer. In reality, if you are improving a process, developing a new product, or even writing custom code for your e-commerce store, you may qualify. Unlike a deduction, which reduces your taxable income, the R&D credit is a tax credit. This means it reduces your tax bill dollar for dollar. If you owe $10,000 in taxes and you have a $10,000 R&D credit, your tax bill becomes zero. In 2026, the IRS has made it easier for qualified small business startups to apply this credit against their payroll taxes. This is huge. Even if your business isn't profitable yet, you can use this credit to stop paying the employer portion of Social Security taxes, keeping that cash in your business to hire more people or buy more inventory. To claim this, you'll need to work with a specialist who can perform an R&D study to document your hours and expenses, but the ROI on this study is often 10 to 1. Finally, for this section, let's talk about healthcare. For a small business owner, health insurance is often the largest expense after payroll. Loophole number 8 is the QSEHRA, Qualified Small Employer Health Reimbursement Arrangement. Instead of trying to find a complicated group health plan, the QSEHRA allows you to tell your employees, including yourself, go find whatever health insurance you like, and the business will reimburse you up to $500 a month tax-free. This is a triple win. The business gets a 100% deduction for the reimbursement. The employee gets the money 100% tax-free. And because you are an employee of your own S-Corp, you can use this to have your business pay for your own family's health premiums. It's a way to bypass the high costs of traditional corporate plans while still getting the maximum tax benefit allowed by the law. Now, let's talk about one of the most enjoyed tax strategies: the business travel sandwich. We all need to travel for business occasionally, to meet clients, attend conferences, or scout new locations. But the IRS allows you to turn a standard business trip into a partially tax-deductible vacation if you understand the Saturday night rule and the sandwich strategy. Here's how it works. If you have a business meeting on Friday and another business meeting on the following Monday, the IRS considers the weekend in between, Saturday and Sunday, as necessary days to stay at the location. Why? because it's often cheaper for the business to pay for your hotel for 2 days than to fly you back and forth twice. This means your flights are 100% deductible. Your hotel for Friday, Saturday, Sunday, and Monday is 100% deductible. Your meals on those days are deductible. You effectively just had a weekend at a resort, and as long as you are conducting legitimate business on the bread days, Friday and Monday, the meat of the sandwich, the weekend, is covered by the business. To make this bulletproof, you must prove that the primary purpose of the trip was business. Keep your conference tickets, email threads with clients, and a clear log of what business goals were achieved. You are allowed to enjoy yourself, but the IRS needs to see that the profit motive came first. Loophole number 10 is a gift from the 2017 Tax Cuts and Jobs Act that is still going strong in 2026, the Qualified Business Income Deduction, or Section 199A. This is essentially a 20% off coupon for your taxes. If you qualify, the IRS allows you to deduct up to 20% of your total business income right off the top before you even start calculating your tax rate. If your business made $100,000 in profit, the IRS might only tax you on $80,000. There are income limits and specified service trade or business (SSTB) rules which apply to doctors, lawyers, and consultants, but for most regular businesses, this is a massive win. The key here is to make sure your taxable income doesn't exceed the yearly threshold where the deduction starts to phase out. A savvy business owner will use other deductions, like the ones we've mentioned, to keep their taxable income below that threshold, just to keep this 20% QBI deduction alive. It's a game of chess, and this deduction is one of your most powerful pieces. If you are a solopreneur or a business owner with no full-time employees other than your spouse, the Solo 401k is arguably the best retirement vehicle in existence. Standard employees are limited in how much they can contribute to a 401k. But as the business owner, you are both the employee and the employer. This means you can contribute as the employee, up to $23,000 plus per year, and you can make a profit-sharing contribution as the employer, up to 25% of your compensation. In 2026, the total contribution limit can be as high as $69,000 or more. Imagine taking $69,000 of your business profit and moving it into a retirement account. You just lowered your taxable income by $69,000 today, and that money will grow tax-deferred for decades. If you choose the Roth Solo 401k option, you don't get the tax break today, but you will never pay taxes on that money or its growth again. This is how you build generational wealth while the IRS watches from the sidelines. Number 12 is about board meetings. Many small business owners make the mistake of thinking they don't need a board because they are the only owner. But by formally appointing a board of advisors, which could include your spouse, a mentor, or a business partner, you create a legal requirement for meetings. When you hold a board meeting to discuss the annual direction of the company, the expenses associated with that meeting are deductible. If you meet at a high-end restaurant to discuss the Q4 strategy, that meal is a business expense. If you travel to a quiet location to have a board retreat and plan the next year's expansion, that travel is deductible. The key is formalization. You need a written agreement appointing the advisors, you need to take minutes of the meeting, notes on what was decided, and you need to keep it focused on the business. It's a legitimate way to ensure that your strategic planning sessions are funded by pre-tax dollars. In 2026, information is the most valuable currency. Loophole 13 allows you to deduct 100% of the cost of your professional development. This goes far beyond just college classes. Are you part of a $15,000 a year business mastermind? Deductible. Did you buy a $2,000 online course to learn how to implement AI in your workflow? Deductible. Did you fly to Vegas for a marketing seminar? The ticket, the hotel, and the flight are all deductible. The IRS likes to see businesses getting better and more efficient because more efficient businesses pay more taxes in the long run. As long as the education maintains or improves the skills required in your current business, you can write off the entire cost. This is the government effectively subsidizing your growth as an entrepreneur. Number 14. Don't just give to charity, sponsor an event. When you give money to a nonprofit as an individual, it's a charitable contribution subject to many limits on your Schedule A. However, when your business sponsors a local Little League team, a charity gala, or a community event in exchange for advertising, like having your logo on a banner, that money moves from a personal deduction to a marketing and advertising expense. Marketing expenses are 100% deductible and are not subject to the same strict limits as personal charity. You are still doing good in your community, but you are doing it in a way that provides a clear business benefit, branding, and a superior tax benefit. Finally, Loophole 15, business asset harvesting. We often hear about this in the stock market, but it applies to your business too. Do you have old equipment sitting in the corner that you don't use? Is there software you paid for but never implemented? Or perhaps a project that failed? Instead of letting those dead assets sit on your books, realize the loss. Sell the old equipment for a loss or document the abandonment of the asset. This loss can be used to offset the gains and profits your business made elsewhere. At the end of the year, a savvy owner looks for everything that didn't work and uses those failures to reduce the tax bill on their successes. It's the final step in a year-round strategy to ensure that not a single dollar is wasted. We've covered 15 powerful legal and strategic loopholes, from renting your home to your business to hiring your children and maximizing your 401k. If you've made it this far, you now have the blueprint to save thousands. But here is my final piece of advice. The most expensive thing you can buy is a cheap accountant. Take these ideas to a proactive tax strategist, someone who looks forward, not just backward. If you found this video masterclass valuable, please hit that like button, subscribe, and share this with one fellow business owner. Let's keep more of our money and build a stronger economy together. Thank you for watching, and I'll see you in the next deep dive.